Hi, as a trader with 35 years of trading experience under my belt, I'm often asked by budding traders as to what is more important, traded volumes or open interest. What they would or what they should rather be looking at as a priority. Now do remember that many of us grew up on the first edition of Classics, the books which laid the foundation of our technical analysis knowledge, and these books were written by stalwarts of technical analysis who started their careers in the 1950s, 60s and 70s, and unfortunately for them, derivatives in equity and currency futures were ushered in much later or took a huge amount of time to gain popularity. So, many of the early technical analysts like Joseph Granville, who emphasized on volumes, J. Wells Wilder, there are a whole lot of others who say that volumes are more important even than the price. I completely agree that volumes are extremely important. But in this day and age, when derivatives are now available for almost every asset class, can you really ignore open interest? Open interest basically for me indicates the commitment or the conviction level of the traders who are telling me that they will write out checks, wait overnight, and are convinced enough to pay even mark-to-market pay-ins to the broker to keep the trade going. Let me just clarify my point of view. Take a look at your screen. What you are seeing is a quick view or a Snapcode window of Indian Oil Corporation or IOC. It's an oil marketing company, a publicly owned company by the government of India, and the market lot of this future is 6,500 shares. Now, if I was to buy one lot and sell one lot, I would have done a turnover of 13,000 shares. If at all, hypothetically speaking, Indian Oil Corporation quotes at 100 rupees per share, I would have created a turnover of 1.3 million without being convinced or even bothered about where the share is actually headed. Hey, if you were actually to look at the right hand side of this Snapcode window, you will realize that that's precisely what happened. Look at something called G/L, that is gain or loss. I traded this stock. I made 2,275 rupees without even bothering to see where the share is headed. I was in and I was out. All right. And this is not even the end of the trading session. Now, what I have done is I have made a little bit of money, a tiny bit of money, without taking a positional view on the stock. So there are a lot of traders like me. As a matter of fact, if you actually read the FAQs on the NSE's website or any other financial website of serious content, you would see that 4/5 or more of the turnover in the daily turnover category on financial exchanges in the country or maybe even the world over comes from derivatives, not from delivery or the cash segment. All right. So majority of us are day traders who want to get in and get out, so the turnovers may be rising. It is a minority which basically writes out a check, gives money to the broker and says, look, I'm willing to pay mark-to-market margin, but I will not square up my trade unless I get my desired profits. To me, this is a level of commitment. If this level of commitment is rising along with rising prices, it tells me that this stock is in strong hands. So while volumes, I do agree, are extremely important, if with the volumes open interest is also rising, I receive double the amount of comfort, conviction, and the fortitude and basically the motivation to raise my stakes on that counter. So, what if a stock was rising and the volumes rose 10%, but the open interest did not rise. This is case A. Case B, stock is rising. Volumes may or may not rise, but the open interest has risen 10%, which means 10% more people have come, given checks to the brokers to carry their position over for the next day, willing to take mark-to-market risks, but not squaring up their trade. What do you think is stronger? The scenario in case A where volumes rose but open interest did not, in case B where price rose but no volumes, although open interest went up 10%. I would clearly go for case B where open interest rose with the price. This tells me that my view is being shared by a whole lot of other people who are not just talking, but they are also writing out checks. They are expressing their commitment to the stock's rally by actually risking their money and putting it on the firing line. That's what's more convincing. Now, where do you get these figures? You get this on the Snapcode window, like I showed you on Indian Oil Corporation. Here you see it on your screen. By highlighting the security and most of the trading terminal softwares, if you click on F5, this Snapcode window opens up. This is like a trader's cockpit. It gives you many signals that a trader has to look during the day, during the trading session, before he can initiate a trade. Now, what happens if you were to buy a stock for delivery and you're not interested in derivatives, even though the stock has futures and options available for it? Please look at the open interest. If you're picking up delivery, it's not that you should be completely unaware or completely ignore the open interest figures. You see, after you take delivery, you think the stock is going to go up. If the open interest is rising, which means even the futures traders are agreeing with your view and they are buying along with yourself. In that case, the chances are this stock will give you higher profits and maybe even faster, because there's a whole lot of other people buying also. Now, what happens if you're a pure delivery trader or an investor in a stock that has no derivatives available on it? I think you should not feel sad. The National Stock Exchange in India on its website gives you a daily file called the MTO file. This tells you what was the total turnover in the spot segment, and of the total turnover, what percentage resulted in delivery. Obviously, I as a bull would want to buy those stocks where the volume is high, number one, and number two, the percentage of delivery is relatively higher compared to other stocks. Now, this would tell me that people are writing out checks, taking delivery off the counter, and participating in a more convinced manner in the bull market. So, volumes may be important, but delivery or open interest, in the case of futures it is open interest, in the case of a spot market it is delivery, is a better figure, a better benchmark, which the early stalwarts of technical analysis could not experience because derivatives were not available to them, and therefore they are saying in their early books that price and volumes are the only two things that you need to look at. We must evolve with the markets, which are fast evolving, and if you were to fight a war in the market, and I consider trading as a war, if you're going to fight a war in today's market with the previous century's weapons, hey, you're looking at losing the battle with a near certainty. Friends, I'm Vijay Bhambwani. I'm a trader with 35 years of experience, 28 of which are as a founder, promoter, and CEO of a limited company that trades for a living. My whole and sole purpose of recording these videos is to help you become better traders. So if you like this video, please subscribe to my YouTube channel, click on the bell icon, and in the comments section, do let me know what you think of this video. Also, it would help me if you would share these videos with your family and friends. It would help me to reach out to like-minded traders who are looking out for cutting-edge, commonsensical 360-degree worldview on financial markets and knowledge-based trading and investment techniques. I wish you have a very, very profitable day ahead. Vijay Bhambwani signing off for now. Thank you for watching me. Till we meet again in my next. Bye-bye.